This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So I want to talk about an important topic on this week's podcast that we haven't really had a chance to discuss in all of the years that I've been doing this podcast, and that is signs that value stocks are in a new bull. Now, I'm going out on a limb there because I know I've predicted, good things are coming for value stocks several times over the years. And we've had these kind of mini rallies in value stocks. But there's been a few things that have come to my attention in recent months that make it seem pretty clear that the value stocks are now in a new bull. And that doesn't necessarily mean they're all going up or, that they're suddenly beating NVIDIA or anything like that. But that growth is maybe going on the out and value is coming on to the in. And that's good for us, right? Because we've been waiting a long time to have value stocks finally be in some kind of sustained bull. And many of them have actually been in a sustained bull for the last couple of years. And we ourselves have been ignoring it because we've been so conditioned to believe that value is going to lag growth because it has been, that it will continue to do so. But I'm here to report that there's these three signs that value stocks are now in a new bull. And I'm calling it now, calling it here in August of 2024, that this new bull has started in value. So what are these signs? Okay, so the first one is Berkshire Hathaway, the B shares are at new highs. Now, they've been hitting new highs the last couple of years, actually. So that's not that strange. But they're starting to hit highs at times when maybe they shouldn't be. So, for instance, here in the summer of 2024, we have discovered that Berkshire Hathaway sold out of 50% of its Apple position. And normally that would hit Berkshire Hathaway stock, right? Because that was one of the four pillars of Berkshire Hathaway, one of the key holdings of the equity portfolio, one of the, best companies that Berkshire has ever owned. And that's in Buffett's own words. And now they've reduced their position considerably. But the stock has actually managed to go to yet another new high, even within a week after hearing the news. So that tells me there's real bullishness behind Berkshire Hathaway right now. And the stock isn't altogether cheap. So even Berkshire Hathaway might actually be on the kind of the growth side of things. And it's trading at 22.9 times forward earnings right now. And it has a PEG of 3.3, which is, not cheap. We always look for a PEG of 1 and under because the PEG ratio is the PE divided by the growth. And if you can get that below 1, that means you have both value and growth going on. But this isn't below 1. This is at 3.2. And that's actually kind of high. So this isn't a cheap stock anymore yet. People are still diving into it anyways. And that kind of tells me what is trending out there, that usually when value is out, Berkshire Hathaway is not in favor. People don't want to own it. They consider Buffett to be, out of date or, not with it enough to know the growth story, and it's going to lag. So why should I own that? But you can see that they are still pouring into it here. And we know Berkshire, other than Apple, it owns a lot of companies in the equity portfolio that aren't exactly growth, trailblazers. It owns a lot of insurance, for instance, which has historically been value type of area. And on the businesses, it owns a railroad. Of course, it owns Geico, which is, again, insurance. It owns some of these like slower growing businesses, like the Clayton Homes. It owns auto retailers. It owns See's Candy and Dairy Queen. Nothing there screams growth or AI or innovation. None of it. But yet people want to own it. That's why they're diving in. And year to date, I think people would be surprised with what Berkshire's doing, even though it is hitting its all-time highs now. It's up 23% year to date. The S&P 500 is now up 18.7. So it is slightly beating the S&P 500. But even with the AI story still going loud and clear, it's beating Microsoft this year. Microsoft only up 14.3% after it's pulled back off of its recent highs. And so it's easily beating Microsoft there. I'm going to take a look and just see if it's also beating Alphabet, because I'm curious now. But that's another sign, right? Why is this old conglomerate beating these, AI heavy names? Okay, so it is beating Alphabet as well, but that's doing a little bit better than Microsoft. Year to date, up 20%. So, and Berkshire's just about at 23%. So yeah, one of the first sign, Berkshire Hathaway hitting new highs, outperforming the AI stocks, or at least some of them. And also Warren Buffett is kind of in favor again. You don't hear anybody talking about how he's out of touch. He doesn't know what's going on. How dare he not own some AI stocks? How dare he sell Apple? You don't hear any of this really. You hear people like myself even questioning why he sold it and the reasons behind it, but we're not hearing the usual stuff we heard in the big growth type of markets like the late 1990s. So there's a lot of reasons to buy into this sign that value's in a new bull, but Berkshire Hathaway, the ultimate value type of company, and it is busting out to new highs. So ticker there, in case you want to go check it out, is BRK.B. I don't own it in any of my portfolios. I used to own it in Insider Trader for the last prior year, but we did cash it in on one of the highs and took a nice gain off the table on Berkshire because let me see what it's done over the year. So over the year, it's up 26%. So that's still a nice return. And over the last year, Microsoft, Google, and the S&P 500 are slightly outperforming it. Microsoft up 31%, Alphabet up 29%, and S&P 500 up 27.6%. And then you had Berkshire up 26.6%. So just this year, it's starting to outperform, and that's a sign we're in a new bull market. Okay, number two sign, and this kind of goes into even just what I was just talking about. Old economy is now beating the new economy. And that means those stocks are starting to outperform. The boring ones everybody hates, like United Rentals. United Rentals, year to date, the shares are up 27.9%. Comparing it to some big name growth players, ROKU down 30.5%. TWLO down 16, and even the mighty Shopify, as I like to call it, it's up only 2% year to date. And again, United Rentals just has rental equipment for many industries, rental construction, and that's up 27.9%. Now, obviously, I've talked about in the past about how the infrastructure play is super hot. So it shouldn't really be a surprise that one of them, like a United Rental, is outperforming. But that's when we see the rotation into these types of value names. I just took a quick look at another old economy type stock that I've liked for a while. It's still not cheap. So I'm not even sure I would put it into value, but most people would because it's old economy, and that's Sherwin Williams, the paint manufacturer. And year to date, those shares are up 21%. So again, these old economy type names that people associate with value, even if their valuations are a little bit stretched, like Sherwin Williams, are still outperforming these growth names that were the big winners in the prior growth bull, and they haven't really come back. So I've been saying for a while that the AI revolution is really disguised the weakness in a lot of the growth stocks. So if you look beyond Microsoft, Alphabet, NVIDIA, any of the chip names, the super microcomputers, anyone like involved in the data centers, and you look just at these other growth names like the Twilios, the ROKUs, the Shopifys, PayPal, those stocks, Teladoc, then you'll see that those have really still remained depressed for the most part. Even though some of them are off their lows, they are still underperforming these other types of names I'm calling old economy because they may or may not be like true values here. But, the ones that were kind of always basically ignored by the street. So, this is another sign that things have changed. Nobody's really caught on yet because the AI is kind of masking where the weakness is, but we've caught on. And if you've been paying attention to some of these old economy stocks, you know that it's pretty hot out there in some of these names. Another area that was ignored that has been value for a long time is in big pharma. And that was in a growth bull in the 1990s, along with the dot-coms. And then it's really been in a 24-year down period, a secular bear for most of that period. But now, we're in a new age where we have some new drugs that are really pushing these companies up to new levels, and they've entered they were values and now maybe are some of them not values because they're too red hot, but others still kind of keeping their value proposition. And those are still somewhat being ignored by the street. And we know value stocks are stocks that are being ignored. They will have cheap valuations as well, but also the street really just isn't paying them any attention. So the big pharma stocks that are being paid attention to are the weight loss companies. So like Eli Lilly, it is up 61% now year to date. It's rebounding once again. Some of the others that don't have the weight loss drugs are still somewhat lagging. Pfizer, it's down 2%. Merck is up just 2.6%. But AbbVie, a stock I own in Zach's Value Investor, and we've owned it for several years now, and I own it in my own personal portfolio. AbbVie, maker of Botox, but also finally having a few newer drugs that are replacing some of the lost revenue from its big blockbuster Humira arthritis drug. That stock is now up 23% and hitting new 5-year highs. Nobody's talking about it. Nobody's mentioning it really because we're all still focused on the AI story, or possibly, we are focused on the weight loss because that has been just a phenomenal breakout in those companies that have those drugs. But this is another sign of, value and that it's turned a corner. We've gotten a bust out of several of these big pharma companies, and they haven't done this in, again, 24 years. So that's when you see value, things down in the dumps, turning it around. Now, I would like to say that, I would like to add that the banks, could be a signal for that value is in a new bull, because that's the other value sector that has really lagged since the Great Recession. So 15, 16 years now, we're still waiting on the banks to turn around. And then if the banks do, maybe we're really in like a very strong bull in the value stocks. But while some of the big banks have broken out to new highs like JP Morgan Chase, many of the community and the regional banks, the much smaller banks, have not. They're still kind of in that narrow trading range. I'm still waiting, in some cases patiently, to get that breakout, but we still haven't really gotten it yet. So it's not a sign on this podcast, not yet. But I feel like these other signs are still strong enough that they are signaling we're in a new bull. That should be a positive thing that will happen with the banks, but they are lagging a little bit here. Another sign, so the third sign that value is in this new bull, are that the growth stocks themselves have become values. They have fallen so much and are being ignored so much that those now are values. And some of those are one that I've talked about on the show because it's showing up in my value screens. And I'm like, what's going on? Why is no one buying this? And I finally bought it for Zach's value investor portfolio over the summer. And it is Block, ticker SQ. And the growth trajectory is just really strong on Block right now. And that's another sign that growth is over, value has come back in. This Block actually has the growth. It has a PEG ratio of just 0.55 and a PE of 18 right now because, that PEG is low because of the growth side of things, but the street doesn't care. The stock still remains depressed. It is off of recent lows, but it still is not really going anywhere. Earnings expected to be up 98% this year. 98%. Nobody's talking about it. Nobody's buying it because this was a growth play. And it still is. It still is a growth play. Revenue up about 12%, so double-digit revenue. Again, now trading at 18 times, but nobody cares because the growth stocks have become values to some extent, not dirt cheap, but values nevertheless. And they're values because they are also being ignored. Nobody's buying the stock. You're going to have to be patient in these growth stocks that become values because they can stay kind of down here in no man's land for quite some time. Because value investors are diving into the older value types of stocks, the old economy type of stocks, the ones that have been in the doghouse for, a decade or more, like the drug stocks, or like a stock like United Rentals or these other like manufacturing and those types that are normally associated with value, even insurance. Some of those that have taken off, normally people are, consider those to be values. So they're diving in, and value investors are still willing to dive into those types of stocks. Another one you might want to follow is Lululemon. So this was a big time growth play, right? This is the apparel retailer. They've got the yoga pants, but shares have come down so much off their highs. It's now trading at 18.3 times forward earnings. We haven't yet gotten earnings. They're reporting on August 29th. So if you're listening to this in September, they have already reported. But depending on what happens there, if they lower estimates or something, then we'll see the stock may continue to sell off on that kind of news. And it could get cheaper, but I would expect, estimates to come down a bit. Right now, they're showing about 11.7% earnings growth this fiscal year and almost 10% for the following fiscal year. So still getting some double-digit earnings growth there on about 10% sales growth expected for both years. But we know some of the struggles they're having in China with the slowdown there and the consumer spending there. And some analysts are concerned about competition for consumer money here in the US and Europe as well. There's a couple of new competitors like TWLO that are out there that could be stealing some market share, but that remains to be seen, and we will soon find out from earnings there. Now, I own this one in my own personal portfolio. I've owned it for a couple of years now, at least 5 years, I think. But I did take some off the table in the 2022 growth stock sell-off because I felt then that the growth stocks might be kind of seeing the end, the demise of the growth bull, and value would come into play. But it's been fits and starts since then, and now here we are 2 years later, but the growth stocks do seem to be reverting to the mean, as I like to call them, where you will pay less now for the LULU shares, and then they become like a value stock. So we'll see. We'll see if this one can get even cheaper than 18.4, but that puts it in kind of the area where Block is, but it doesn't have nearly the kind of earnings growth like Block is showing right here. But yeah, Lululemon, possibly a value stock here. And certainly it's been abandoned by the street. Shares are down really big now off of those highs for sure. But even year to date, let me look. So yeah, these are just two. I could find many other examples of these kind of growth names that are now become values. But you get the drift, and I know you follow or own a lot of the value stocks or growth stocks that have now taken a dive, and you know the pain. Okay, so I'm just looking at year to date. Lulu's down 47.7%, and S&P 500 again is up 18.8 year to date. So that's quite the disparity, but that's where you do get some buying opportunities in these growth names. But as I mentioned with Block, you might be waiting around for quite some time for the street to recognize, hey, this is no longer a growth, or it is a growth, but it's now also a value. So we're going to dive in. Instead, they are diving into AbbVie, Eli Lilly, but that's, definitely not an unknown story or not cheap anymore. And some banks like JP Morgan, but also Sherwin Williams and United Rentals and those types of old economy stocks. So where does this leave us? We have Berkshire Hathaway at new highs. Warren Buffett is in favor. We have the old economy stocks beating the new, at least in 2024. And then we have the growth stocks that were the big winners of old becoming values, still being ignored by the street, even if there's still growth there, like at Block. And that's a huge sign that now it's value that is taking the center stage, not growth. And this is good. This is good for us, value investors. Now, I do think the street still is in denial. It still is not recognized that this rotation is happening and ongoing, but that's because the AI is masking it. But strip out the AI story and just look at some of these non-AI growth names, and you'll see what's really going on there. So I encourage all value investors to be invested in value. That includes the home builders. I like the commodities plays. They do well when there's a value bull market going on. That includes energy. That includes the metals, including like gold and silver. That can include even things like steel, all of that. But that's a caveat. Some of those are somewhat weak right now because of the weakness in China, which is the second largest consumer of some of the metals, like, say, copper. So you're really going to need a big boom in the US and possibly Europe to keep those metal prices higher. But, check out some of what's going on with gold and silver. The gold is hitting new highs, and that could be an interesting play. The energy stocks have pulled back, and they're pretty depressed here, actually. The street is abandoning them once again, so you can get some cheap deals in some of the energy stocks. I'll probably do a follow-up podcast on some of those again in the fall, because that is an area where it remains cheap. But take a look at those value stocks, because good things are happening. We're going to be good. We're going to be in again. And this is exciting. I know there's been some false alarms, as I mentioned earlier, but I do think that these signs are going to stick here, and there may be different this time. We'll see. But let me recap the stock tickers I talked about on this episode. So, of course, there's Berkshire Hathaway, ticker B as in boy, R as in Robert, K as in kite, .B or /B, depending on what website you're on. But it does have the B shares and the A shares. But these are the B shares I'm talking about. Then we talked about United Rentals, ticker U, R as in Robert, I, URI. We compared it to Shopify, which is SHOP, TWLO, TWLO, and Roku, R as in Robert, O, K as in kite, U, ROKU. And we also talked about Sherwin Williams, also bouncing back here in 2024. Even though paint volumes are low, that also tells you what is going on out in value, right? Things are not that great at Sherwin-Williams right now, but the stock is up for the year and it's outperforming the S&P 500. So ticker S as in Sam, SHW. I mentioned some of the banks. We're still waiting for an entire banking industry breakout, but JP Morgan has been busting out to new highs. Ticker J as in John, P as in Paul, M as in Mary, JPM. And then we talked about some growth stocks that have become values, but the street still ignoring them and doesn't care. And that's Block, ticker SQ. I own it in the value investor portfolio. And Lululemon, ticker LULU, which I own in my own portfolio. And they will be reporting earnings on August 29th. So you're going to want to tune in for that one. So there's a lot going on with value stocks. I could go on and on with some really good quality value stocks that have good Zacks ranks with rising earnings. And I will do so on the future episodes of this podcast. So you want to be sure to tune in now that it's our time. Don't miss a single episode of the Value Investor Podcast. You can get us on Apple. We're on Spotify. We're on Amazon Music. You can also get us on YouTube on our own channel, on Zach's podcast channel. You can find it there along with ETF Spotlight. Don't miss that one, but be sure to get us somewhere. And I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.